The Healthcare Labyrinth podcast is back for another episode. Join Mark S. Ryan, a veteran health plan and health technology executive, as he explores the world of healthcare.
Welcome, everyone, to this edition of the Healthcare Labyrinth podcast. My name is Mark Ryan, and it's a pleasure to be hosting the podcast, and thanks to everyone for listening in. Today's topic is going to cover the health insurance industry in general, but more specifically, how the big, mighty healthcare companies have fallen. They've fallen, and in this case, they're a victim of their own financial mismanagement and shenanigans. We will break this down a bit because it will get a little bit complex. First, we will talk about what is driving financial problems across the entire health insurance industry. Second, we will get into the financial status of the health insurers right now over the past few years. Third, we'll get into how big healthcare built their businesses, how they seem to stand the financial test of time, but now their approaches may be coming back to haunt them. And last, we'll bring it all together. We'll look at the differences between the big guys and the rest of the guys, what the big guys did wrong, what the smaller guys did right, and how plans need to pivot to get back to margin. It could be that the smaller guys have an advantage right now. We'll take 4 breaks today to split this up, so let's get right to it. The struggles and, in some cases, the near implosion of several large nationally vertically integrated health plans, or big healthcare, has been surprising to many, including me. The biblical phrase, "how the mighty have fallen," from Samuel seems particularly relevant right now. David's lament for King Saul and Jonathan indicates no one is immune from hardship, not even the long-standing go-to investments in healthcare. Big healthcare certainly had some external forces undermining its health, but it too was a victim of its own financial mismanagement and shenanigans. The crash offers some insights into the wrong way to attack running a health insurance business these days. So let's get to our first topic here, the industry as a whole and what is impacting it right now. So, utilization has gone up considerably recently. A good share of this ties back to the tremendous drop in normal medical utilization during COVID. Utilization began recovering in 2022, but has really taken off since then, and there appears to be no sign of a slowdown right now. Costs are surging as well. Cost trends have been 5% or more since 2023. Costs are up annually between 6 and 9% through 25, and similar trends are expected in 2026. Driving the costs are, again, a return of utilization, trends in specialty drugs, and the use and penetration of GLP-1 weight loss drugs. And also, rates and government programs have impacted bottom lines. The Centers for Medicare and Medicaid Services, or CMS, announced a new risk model in Medicare Advantage that took over 7% out of rates over a 3-year period. This meant a negative rate hike for 2024 and 2025. Initial hikes for MA for 26 were just 2.23%, but surged in the final announcement in April to 5.06%. But plan actuaries indicate that MA trends are as high as 9%. So while that final increase for 2026 of 5.06% is welcome, it does not solve all the financial woes insurers are looking at. In Medicaid, too, plans saw major rate hikes during the COVID years because of surging enrollment and a plethora of additional federal funding available to states. But with redeterminations coming back and the end of enhanced federal reimbursement, Medicaid managed care plans are now seeing rising adverse selection as rolls are trimmed and there are much tighter rate hikes from states. With that, we'll take our first break, and when we get back, we will look deep at the health plan's financial pictures.
Health plans and insurance are confusing. Our healthcare system is in dire need of reform. Health policy expert Mark Ryan tackles both issues in his book, The Healthcare Labyrinth. It is both a guide to navigating health plans and fixing American health insurance. Mark dives deep into how health plans and the American health insurance system operate. He then outlines a comprehensive reform agenda for the system as a whole, including pricing, emphasizing health and care management, and ensuring affordable access to health coverage in a private delivery model. Mark is a bit of an unconventional Republican in that he believes affordable access is the morally right thing to do, and that it is also fiscally prudent for our nation. Learn more about Mark's book, The Healthcare Labyrinth, at healthcarelabyrinth.com or search at leading bookseller websites. Available in print, ebook, and audiobook forms.
Welcome back, and we hope you're enjoying this episode of the Healthcare Labyrinth podcast. We are talking about all things insurers, in particular, how the mighty big healthcare plans have fallen. So we promised to talk about the health plan's financial picture, and we'll see these impacts on margins here in the second segment here. All of this has brought some of the poorest margin results throughout the industry. The consulting firm McKinsey & Company published a study analyzing the profit of various sectors within the U.S. healthcare industry. I looked closely at the projections for health plans in MA, Medicaid, and the employer sector. On Medicare Advantage, McKinsey says that MA margins saw pressure in 2024, dropping to 1 to 1.5%, with 46% of entities below EBITDA break-even in 2023. Again, the causes were lower rate hikes, the new risk model, a 5% rise in cost due to utilization, and the impact of the Inflation Reduction Act on Medicare Part D. The IRA lowered beneficiary cost sharing and shifted major costs to plans. Star performance could continue to complicate things as well. McKinsey says that a recovery of 150 to 200 basis points should occur in 2025, leading to a rebound to long-term margins of 3 to 3.5% by 2028. McKinsey says the recovery will occur due to product optimizations, which have already begun in 25, market consolidation, and smaller loss-making carriers exiting the market. Lower member acquisition and greater value-based care penetration could factor in as well. I tend to agree with McKinsey's assessment on MA. MA plans have realigned products and geographies and will continue to do so. They are investing heavily in special needs plans. The 5.06% rate hike helps plans to hit targets. The one unknown, however, is how long will major trends in utilization continue, and could this derail plans? Certainly, the United announcement recently we'll talk about in a minute raises some questions. On Medicaid, McKinsey says that a decline in Medicaid enrollment could shift the risk mix adversely further and further strain margins compared to peak levels in 2021 and 2022. We clearly are seeing this. While health plans are urging states to align rates with greater adversity as rolls drop, state revenue is much tighter with the loss of enhanced Medicaid monies, as I noted. McKinsey also points out that Medicaid hikes tend to trail recognition of utilization and other changes demonstrably. It says rates should move up, but it could take 18 to 24 months. And on employer, McKinsey says EBITDA for the commercial segment declined from $17 billion in 2019 to $13 billion in 2023. It says health plans likely will raise premiums by 2.5 to 3 percentage points more than the historical range to compensate for higher provider rate hikes, higher utilization, and other increased costs. McKinsey also sees a trend of less generous plan offerings. McKinsey estimates the commercial segment's EBITDA margins to recover by 2028 and reach $21 billion. Margin percentages are expected to remain below pre-pandemic levels. McKinsey sees a further shift from fully insured to self-insured businesses as premiums rise. At the same time, McKinsey notes that while utilization is rising and rebounding post-COVID, certain services have not yet fully recovered, and there should be a shift toward non-acute settings. Interestingly, McKinsey says that by 2028, government business is expected to generate 75% more EBITDA than commercial. Important to remember, this is pure health insurance, not the revenue from other service, PBM, and other assets that the big vertically integrated companies have. How badly are plans doing? Well, let's look at that and how they compare to other healthcare businesses. Health plans had negative margins while providers turned a small margin. Pharmacy and services or technology maintained strong margins. It is important to note that much of big healthcare has vertically integrated, so their margins have the strength of these pharmacy and services and the drag of health plans and providers. Here are the exact numbers, and here is compound annual growth EBITDA from 2019 to 2024. Providers, which are hospitals, health systems, and physicians, had a growth rate of 1.8%. Health insurers, negative 1.2%. Healthcare services and technology, 8.5%. Pharmacy, which is PBM, specialty, and retail, and 7.5%. And that totals up to about 3%. With that, we will take our second break. When we get back, we will look at big healthcare, how it built its business, and its woes. Be right back.
Lilac Software is proud to work with the Healthcare Labyrinth website to educate people on the healthcare system. At Lilac, we believe transparency is so important in healthcare. The healthcare system is opaque, and Lilac is trying to bring clarity to data and unleash the best member care, reduce costs, and improve outcomes. Our cloud-native payer platform revolutionizes data insights and analytics. Plans have all the data they need, but in silos locked away in point solutions. At Lilac, we solve the data fragmentation problem and help plans turn complex data into actionable insights, leading to greater operating leverage, tight cost controls, and healthier members. Health plans can improve STAR scores, reduce medical expense, drive revenue, and more. Quite simply, with Lilac, you can drive better business and health outcomes. Learn more at lilacsoftware.com.
Welcome back, and we hope you're enjoying this episode of the Healthcare Labyrinth podcast. We're talking about insurance and, in particular, big healthcare and how it has fallen. So let's get to our third topic here, big healthcare. Let's first talk about how big healthcare built their businesses. So, number one, let me talk a little bit about horizontal integration versus vertical integration. These are two very important topics in healthcare. So horizontal integration is when a like entity merges with or acquires a like entity. So a health plan acquires a health plan, a provider acquires a provider, a PBM acquires a PBM, and so on. But a vertical integration is when various healthcare entities in the healthcare ecosystem acquire or merge with each other. Let's look at the United Healthcare example. They have built a vertically integrated empire over time. So you have the health plan, which is known as United Healthcare. You have what are known as services and technology entities. That is called Optum. And again, it's a significant tech and processing entity. For example, Change Healthcare is within that. And we heard a lot about Change Healthcare given their cyber attack that pretty much brought the entire healthcare system to a stop in 2024. Then we have a PBM within United Healthcare, and that is Optum Rx. And then we have provider groups within Optum, the service entity as well. So you can see all of this healthcare ecosystem is within United, and the master company is called United Health Group. Over the years, these type of big healthcare entities, vertically integrated types that were replicated by other big companies as well, They had investors flocking to them, and they were cash machines. If one area was weak, say health plans, others made up for it, say PBMs and service entities. That is still the case, but we are beginning to see some vulnerability to these models. Financially, there is clearly more vulnerability. The diversified units are being impacted by the health insurer trends as well. As well, there is criticism that these entities have gotten too big and it's hard to ensure performance of all the different features, and that undermines the success of the whole vertically integrated enterprise. Big healthcare has been going through some major financial woes of late. Many of these big companies reported poor 2024 financials, and some bad news is now popping into 2025. Let's take a look at some of them. United, CVS Health, and Humana have all seen their CEO fired or retired. The most notable failure of late is United Health Group. After consistently reporting better news than most of its peers the past year or so, United has literally crashed. What is going on? United now admits its financial reporting on revenue, medical expense, and margin was far too optimistic. Its CEO resigned or was forced out. Utilization is much higher than anticipated across all of their lines of business, but especially in Medicare Advantage. United's normally strong Optum services entity is also showing weakness due to the ripple effect from the softness of its insurance entity. After all, special and opaque arrangements exist within United to ensure revenue stays within the family. We'll talk about this more below when I discuss intercompany transfers. The company faces numerous probes and lawsuits, many alleging fraud. United's pharmacy benefits manager, Optum Rx, is under scrutiny and being sued for anti-competitive behavior. United brought the healthcare world in America again to a near halt in 2024 after the Change Healthcare cyber attack proved United cared more about acquisitions and revenue than integration and security. There are numerous acquisitions that United has done, which has created anti-competitive behavior, including with its proposed acquisition of additional home care entities. CVS Health saw its insurance entity, Aetna, nearly implode as well, with an overzealous MA expansion in 2024. Its PBM2 is being sued for the same behavior as Optum Rx. It has struggled with its primary care investments and retail pharmacies post-COVID. It also ousted its CEO. Humana's MA-dominant business was the first to report issues. Its CEO retired, leaving the new boss with a years-long recovery to plot. And while Cigna has largely escaped huge problems, similar to Evolent's Health, it has not had huge problems either. Cigna's PBM, Express Scripts, is in the same mess as CVS and United in terms of lawsuits. With that, we will take our third break, and when we get back, we will talk more about how big healthcare has had it better, but that could be changing. Be right back.
The Healthcare Labyrinth is no ordinary website. It features news and commentary from one of the nation's leading healthcare policy and technology experts. Mark Ryan combs the internet for the latest healthcare news and publishes a news feed each weekday with summations and Mark's insights. Twice a week, Mark publishes a blog to go deep into a current issue. And of course, Mark hosts a podcast each week to delve even further. All of this is available at healthcarelabyrinth.com. Visit each day for the latest happenings in healthcare. As well, learn more about Mark's book, The Healthcare Labyrinth, at the website. That's healthcarelabyrinth.com, your go-to source for healthcare news.
Welcome back, and we hope you're enjoying this episode of the Healthcare Labyrinth podcast. We are talking about the health insurance industry, and in particular, the woes of big healthcare. So let's get on to our fourth topic here. Big healthcare has always had it better, but there are new trends that could see big healthcare losing its traction. Actuary Milliman gives us a glimpse of whether the big healthcare plans have had it better than regional ones and smaller ones. It looked at insurance filings to look at the performance of MA in 2023 and 2024, and specifically looked at the differences between national and regional players. Overall, MA Part D or MAPD, medical loss ratios or MLRs, went up by 2.8% to 90% from 2023 to 2024. For MA Part D, underwriting margin decreased by 18.7% on average from 2023 to 2024. Underwriting margin is total premium revenue less total claims cost. This is the amount left to be used to cover admin costs, capital surplus contributions, and profit margin. So that was the entire industry, and you can see an erosion. Where does Big MA have an advantage? Big MA does have an advantage, at least they did, and Milliman found this as well. Milliman found that MA Part D regional carriers experienced loss ratios roughly 4.1% higher than national carriers in 2024, which is slightly lower than the 5.5% gap in both 22 and 23. MAPD underwriting margin was much greater for big MA plans than regional ones, $184 versus $100 in 2023, and $148 versus $85 in 2024. But where did Big MA fare worse recently? Big national players got hit harder recently for sure. Milliman notes that on average, financial headwinds for national carriers were larger in 2024, a 3.1% hit in MLR, than regional carriers, which had a 1.7% hit in MLR. But a large gap remains, again, that 4.1% gap I told you about. I think a good deal of this gap, so-called, could be some of the big healthcare behaviors I talked about and we'll talk about again. Big MA took an underwriting margin hit of $36 from 2023 to 24, or 20%, while regional carriers took a hit of $15 or 15%. Milliman does note that the unfavorable impacts for national carriers are primarily driven by a single player, with a 10% increase in loss ratio in 2024 versus 2023. Excluding that one payer results in a 2% increase in the average loss ratio for national carriers, more in line with regional carriers. It is clear that things are changing for big healthcare. Let's also talk about MA enrollment impacts and how things may be changing for big healthcare. While the MA industry as a whole realigned for 2025, big MA plans took the biggest hit overall. My analysis finds that big MA plans likely contracted much more than other plans, and their growth or contraction footprint shows it. Big MA enrollment rose from 25.568 million in January 24 to 26.348 million in February 2025, an increase of 780,000 or 3.1%. Non-big MA plan enrollment, including the prominent startups, grew at a healthy pace year over year as well, about 688,000 or 8.7% from January 24 to February 25. Again, this compares to just 3.1% for big MA plans. Non-big MA grew about 406,000 during the enrollment season, about 5%, while big MA grew by just 16,000 members, basically flat during that enrollment season. Big MA plan enrollment represented about 76.38% in January 24 and is about 75.41% as of February 25, down by about 1%. More interesting is that only about 53% of all growth from January 24 to February 25 was from big MA plans. Now, Big Plan MA still dominates the program. It is just 3% of all sponsoring organizations, but the decline in its share, ever so slightly, is a sign that big plans are hurting financially, are pulling back on overexpansion, and that other MA plans may be getting better traction. With that, we'll take our fourth break and we'll come back to discuss where big healthcare could have it wrong. Be right back.
Lilac Software is proud to work with the Healthcare Labyrinth website to educate people on the healthcare system. At Lilac, we believe transparency is so important in healthcare. The healthcare system is opaque, and Lilac is trying to bring clarity to data and unleash the best member care, reduce costs, and improve outcomes. Our cloud-native payer platform revolutionizes data insights and analytics. Plans have all the data they need, but in silos locked away in point solutions. At Lilac, we solve the data fragmentation problem and help plans turn complex data into actionable insights, leading to greater operating leverage, tight cost controls, and healthier members. Health plans can improve STAR scores, reduce medical expense, drive revenue, and more. Quite simply, with Lilac, you can drive better business and health outcomes. Learn more at lilacsoftware.com.
Welcome back, and we hope you're enjoying this episode of the Healthcare Labyrinth podcast. We're talking about the health insurance industry and the travails of big healthcare. So where did big healthcare go wrong? Well, big healthcare is clearly relying too much on suspect strategies. What do I mean by this? Well, investors flock to put money into these big names due to their financial reliability and seeming ability to escape the vagaries of healthcare. But these vertically integrated behemoths relied far too much on suspect ways to generate revenue. Many set up robust MA risk adjustment shops that pushed the limits of law or perhaps even stepped over the line. We'll see that based on the outcomes of lawsuits accusing Big MA of fraud. Big MA 2 went heavy on prior authorization and claims denials to lower medical expense. Some big MA entered into unseemly and perhaps illegal agreements with third-party marketing organizations and brokers to steer MA lives to their plans. In all lines of business, big healthcare leveraged vertical integration by entering into intercompany transfers within their broader enterprise. For example, PBMs, physician groups, specialty pharmacies, retail pharmacies, and service entities. By entering into these intercompany transfers, the health insurance entity shielded medical expense from the minimum medical loss ratio law, and it paid itself, in essence, to these other related entities higher than market prices for services and drugs. These big entities also use their size in the market and acquisitions in many areas, including PBMs, to increase price in their return. Well, there's a regulatory backlash. In the end, some of these will continue on and mean returns to investors, but a good deal could go away. Competition regulators could stop further consolidation and perhaps force the breakup of the mega businesses over time. Vertical integration will be investigated and unseemly intercompany deals stopped. Risk adjustment in MA likely will be radically reformed. PA and claims denial reforms have been instituted at the state and federal level across all lines of business, and more will come online in the future. Radical PBM reform will come as well. Lawmakers, too, at the state and federal levels are attacking big healthcare with investigations and other reform activities. So big healthcare was able to leverage its size, other companies, and various schemes to continue to thrive, especially in MA. But some of those tactics are clearly under threat and could go away. Where do smaller regional players have it right? While regional players have been hit by a financial downturn too, their greater focus on member care and relationships, as opposed to the suspect behaviors of the national plans, seem to be helping win the day from a financial standpoint in growth right now. Regional players seem to do a better job at connecting with members, prioritizing care more, and in many ways establishing a more respected brand. So for sure, no one is counting big healthcare out. They have so many assets at their disposal, and they will continue to use them. But its future right now really appears cloudy. With that, we will conclude this episode of the Healthcare Labyrinth podcast, and we'll be back next week. Take care.
Thanks for joining Mark and the Healthcare Labyrinth podcast. Go to healthcarelabyrinth.com each day for the latest healthcare news. See you next week on the next Healthcare Labyrinth podcast.